In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get.
This quote from Charlie Munger to the BBC in 2009, set in the midst of a once-in-a-generation drawdown, yes, the great financial crisis, perfectly captures what any buy-and-hold stock investor should gear up for when investing in equities. And since Charlie first said this quote, the market has steadily advanced, over tripling, while still only having experienced 2 bear markets in 2020 and 2022 that quickly gained back all their losses, and then some. Investors taking Charlie's advice to heart have done nothing but hit the ask during these drawdowns. Today, anytime the market experiences even the slightest hiccup, you hear that you should just close your eyes and hold on for dear life. Or even better, buy the dip. But is there anything problematic with this type of thinking? And is there going to be a time where buying the dip or holding on for dear life is going to prove to be a bad idea? To answer this question, we'll go over the latest Michael Mauboussin and Dan Callahan paper, Drawdowns and Recoveries, Base Rates for Bottoms and Bounces. And by reading it, we're going to draw some conclusions about the nature of drawdowns to see whether holding on for dear life is a smart investing strategy. Before starting though, I have a quick request for you. If you find this content helpful and you want more of it, I'll ask you to like, subscribe, and more importantly, share this video with a friend. This will help our channel grow tremendously. Let's begin. Charlie Munger believed that, and in the words of the authors, big drawdowns are a price to pay for superior long-term investment returns. And I think that's right. If you're going to buy and hold stocks, the likelihood of experiencing a 50% plus drawdown is not just likely, it's almost a given. And if you're a stock picker, that likelihood shoots way up. Here's why. In his paper, Do Stocks Outperform Treasury Bills?, Hendrik Bessembinder studied over 28,000 companies from 1926 to 2024 and found that 60% of stocks underperformed cash over their lifespan. About 40% matched the returns of cash with a whole lot more volatility, and only 2% of stocks account for 90% of the aggregate wealth creation in the sample. Now here's the absolutely crazy part. This should stick with you. According to the paper, the most common result for a stock is a loss of 100%. That's right, a complete wipeout. This is why Jack Bogle, founder of Vanguard, famously said, "Don't look for the needle in the haystack, just buy the haystack." In Bogle's eyes, indexing makes sense because it pretty much guarantees that investors will buy those 2% of stocks that produce all net returns, even if most stocks result in a complete impairment of capital. Stock pickers then have a much lower chance of picking the 2% of stocks that will drive returns just by the mere math of it. But even if a stock picker gets it right and happens to pick the one high-flying stock that will make their portfolio, is there any chance that they would be able to stick with their picks to reap those potential rewards? So here is our first finding for this video. Winning stocks are not easy to hold on to. And here is a fun fact. According to Bessembinder, just 6 stocks accounted for almost 22% of all net gains in the market. And you probably know those stocks. Those stocks are Apple, Microsoft, Nvidia, Alphabet, Amazon, and ExxonMobil. Good names, right? Here is the kicker. On average, each of these stocks went down about 80%. Ouch! I mean, take Amazon, for example, which experienced a 95% plus drawdown during the dot-com crash. Ask yourself, would you have been able to have held onto a stock after a 95% loss? With hindsight bias, maybe. In real time, extremely unlikely. Furthermore, would you have had the fortitude of buying the dip? Would that even be in your best interest? While buying the dip sounds like a great investment plan and one that has been ingrained in our minds given our investment culture, knowing what the dip will be is an extremely arduous exercise and may be a net wealth destroyer if you're writing a stock down to zero, which again is the most likely end result for most listed stocks that do not get acquired. After all, and you know what they say, a stock that goes down 90% is simply a stock that went down 80% and then got cut in half. The math is just stacked against investors trying to pick winners instead of, and in the words of Bogle, buying the haystack. To prove this point, let's look at the Mauboussin Callahan paper. They estimate that the average drawdown of US listed stocks from 1985 to 2024 was roughly 80.7%, while the median was an astounding 85.4%. Interestingly, the median peak recovery from max loss is only a meager 89.6%, while the average is an astounding 338.5%. In other words, the median stock does not ever recoup its losses. Now, you might be asking yourself, how could this be? How could the median stock never recoup losses while the average stock goes on to experience new all-time highs? Here's why. Because averages take into account the outliers, those high-flying stocks that, like Amazon, experience crazy drawdowns, but then go on to have absolutely insane returns afterwards, the average stock not only recoups, but then goes on to absolutely crush. The same cannot be said for the median. In other words, there's a huge positive skewness in the data. So here is our second finding. Single stocks act as lottery tickets. In this exhibit, notice the path of recovery for stocks that have experienced a 75% loss. While the median stock goes on to recover some, it's only a small minority that get to have astounding returns. This affects averages differently from the median. And this should serve as a warning to stock pickers. The odds are stacked against you. Just like buying lottery tickets, the chances of you hitting a winner are pretty slim. But even if you do, because these stocks can experience gut-wrenching drawdowns, it's unlikely that you'll stick with the plan. And that sounds like pretty bad news. Sorry, but investing is an extremely psychologically taxing undertaking. And if you're wanting to embark on this journey, it's likely that you are going to have to ask yourself, what is there to do to stack the odds in my favor? Investing is a game of survival. If you can avoid a complete wipeout, you live to fight another day. And from all I know about the evidence, there are 4 main things that we could do here. The first one is to diversify your portfolio. The more stocks you own, the more chances you have of owning that 2% of stocks that could deliver returns. If you take it to its most logical conclusion, indexing is the way to go. Now, I know exactly what you're thinking. Yes, this is a channel that mainly focuses on factor investing. And if you know anything about Alpha Architect, you know we're not afraid of portfolio concentration. If you want to see a video about how one can think about striking the balance between diversification and concentration, make sure to check out this video where I go over how many stocks investors should own. Secondly, use momentum in your favor. Momentum dictates that stocks with the best one-year returns tend to outperform, while stocks with the worst one-year returns tend to underperform. And while momentum can be a great strategy to select stocks, it can also be a great strategy to filter out stocks. By avoiding those losing stocks from your investment universe and even selling stocks from your portfolio that are big losers, there's a good chance that you'll avoid a stock that is likely to never recoup. In fact, according to Mauboussin and Callahan, the further a stock falls from its peak, the lower its probability of ever again attaining its past apex. Doubling down on the worst losers could prove to be a painful exercise. Therefore, avoid them at all costs. The third strategy to implement is to filter out for quality. According to the paper, a sharp decline in a stock's price can predict financial distress, and that research shows that distressed stocks underperform safer stocks. Intuitively then, selecting stocks that display a certain level of profitability, stability, and improving fundamentals may allow investors to filter out the garbage that might be going straight to zero. This is especially true for investors looking for a bargain via value investing. It's important to differentiate between what's cheap junk and what is actually a bargain, because sometimes cheap things are cheap for a good reason, like most of my Facebook Marketplace purchases as of late.
Oh, brother, this guy stinks!
In that light, quality can be a great differentiated factor to distinguish between those two. Lastly, rebalance often. The more often you rebalance, the fresher your portfolio will be. You see, as information comes out, acting upon that information as swiftly as possible prevents your portfolio from getting stale and your expectations from getting anchored to old and potentially irrelevant information. In conclusion, while HODLing can be an okay strategy at the index level, it could prove detrimental at the individual stock level. That is because the median stock never actually recoups losses, while the market as a whole usually does. On the other hand, when buying the dip, make sure there is a fundamental reason to believe that there will be a turnaround, especially if this stock has fallen a good amount. Spoiler alert! According to the paper, academic research shows that fundamental turnarounds are hard and rare. Historically, about half of stocks do not ever experience any turnaround whatsoever. So, investor beware. If you do want to target more concentrated portfolios, utilizing momentum and quality filters and rebalancing more constantly could help avoid the dogs. Lastly, and in that light, we do recommend you check out factor investing as an alternative to stock picking. If you do want to learn more about factor investing, I suggest you check out this video right here. Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.